We're jumping straight into energy fuels today. Everyone is watching the price action, but the real story is the dual engine of record uranium production and the massive billion-dollar rare earth expansion.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you want this kind of insight, where we really simplify these complex market stories into the fundamentals that matter, make sure you subscribe and hit that like button.
Yeah, our mission today is to look right past that immediate 8.09% stock surge. We want to get to the why.
Right. What's actually behind it?
We need to understand the production growth that's giving them this stability now, and then look at the enormous, multi-decade rare earth plan that could just change everything for them.
Okay, let's unpack this now. We've got two stories happening at once, but the immediate momentum, I guess the reason for that recent pop was a huge win in their core business.
Right, their 2025 performance specifically beating their uranium guidance.
And that's really the foundation of the whole bull case, isn't it?
It has to be. They just hit a home run on domestic uranium production. If you look at their Q4 2025 sales, they came in at 360,000 pounds of U3O8.
That's a staggering number, especially right now when domestic supply is so important.
And it wasn't just a slight beat. It was a 50% increase over what they initially expected for the quarter. That kind of operational success, it doesn't just happen.
50%. That's not a rounding error. That is pure execution. So where did that jump even come from? Was it just inventory they were sitting on, or is this new production?
Oh, no, this was new production. It was driven by really strong output from two key spots, the Pinyon Plain Mine and the La Salle Complex.
Okay.
So what this really confirmed for the market is that Energy Fuels is, they're successfully bringing these American assets online and ramping up volume at the exact moment global demand is spiking. It's textbook.
So the story here is the uranium business isn't just surviving, it's actually thriving. And that operational success, that engine, is what's providing the cash for their huge rare earth ambitions.
That financial stability is absolutely critical. Because if you're planning a 30-year project, a massive infrastructure build-out, your balance sheet has to be bulletproof.
And theirs is?
Theirs is robust. We're talking about a current ratio of, 11.5 and a quick ratio of 8.7. It's extremely high.
For anyone listening, an 11.5 ratio means they have more than 11 times the assets needed to cover all their short-term liabilities. Most industrial companies would be ecstatic with a ratio of 3.
Right. And it's not just liquidity, it's a strategic choice. This cash position underpins everything. The money from uranium isn't going to service debt, it's a war chest. It's directly funding that aggressive multi-year growth.
Which brings up a fair question, a valid critique. If they're generating this much cash, why aren't they paying a dividend or doing a stock buyback?
Because every dollar is going into growth infrastructure. They're building capacity for the next 30 years. Any cash they distribute right now would just slow down the White Mesa Mill ramp-up or, the development of the Vara Mada project.
The market gets it, for now.
Yeah.
It's giving them a premium because it sees they're in that heavy investment phase.
And that positioning, that structural advantage, brings us to what I think is the core of the bull case, the moat.
Let's talk about that, the vertical integration and the White Mesa Mill.
This is where the story goes from just a strong mining company to a national strategic asset. Energy Fuels operates the White Mesa Mill. It is the only conventional uranium mill in the entire United States.
Let that sink in. The only one. But okay, practically speaking, why does owning the only conventional mill matter so much in a global market?
It matters because of geopolitics. It matters because they own the entire domestic supply chain, from digging ore out of the ground to the final product. But the real game changer is that White Mesa is also engineered for rare earth separation.
So it's dual-purpose facility.
Exactly. They can process uranium and they can process rare earth feedstocks, which positions them as the key American alternative to Chinese dominance in that space.
So the moat isn't just about being vertically integrated, it's strategic. They're selling critical materials independence, not just a commodity.
That's it, exactly. They have this unparalleled domestic moat against foreign competitors. They are basically set up to be the key supplier for U.S. nuclear and all the tech sectors that rely on these critical materials.
And if the U.S. government wants a secure, non-adversarial supply chain,
the White Mesa Mill is at the absolute center of that conversation.
Which makes the next catalyst, the rare earth expansion, even more powerful.
Precisely. The mill is the perfect staging ground for this other massive growth driver, the Madagascar project, Vara Mada.
Okay, this is where the numbers start to get really wild. We're talking about figures that might justify that premium valuation we mentioned.
We have to put these numbers in context. This isn't some small side project. The feasibility study projects a post-tax net present value, an NPV, of $1.8 billion.
$1.8 billion.
To be more precise, the discounted NPV is about $1.4 billion with an internal rate of return, an IRR, of 22.1%.
A 22% IRR over a 38-year horizon. That signals an incredible level of profitability and, longevity. 38 years is nearly 2 generations of cash flow.
It's huge cash flow. Over that time, the project could generate over $500 million in annual EBITDA. If they pull this off, the company's entire identity shifts. They're no longer just a uranium supplier. They're a global critical minerals powerhouse.
That explains the positive sentiment we've seen. The news on the production beat and the feasibility study, it all had the highest relevant scores possible. And the overall weighted sentiment is pretty bullish at around 0.42.
The market sees two companies here. You have the stable, cash-flowing uranium producer, and then you have the massive potential-filled rare earth processor, and right now it's buying both.
But anytime you have a story this big, this ambitious, you have enormous risks. Let's look at the flip side. Let's talk about the bear case, because this kind of growth is never free.
Absolutely. We have to be critical. The main pushback right now is all about valuation.
So if the value is tied to all this future potential, what metrics suggest they might be getting ahead of themselves?
It's the price-to-book ratio, the PB. It's sitting at 6.6x, which is high compared to a lot of its peers. For some analysts, that means the stock is already pricing in the full, perfect success of Armada.
So you're paying a premium for future earnings that aren't there yet. That's always risky.
It's a bet on management. But you mentioned growth isn't free. Let's talk about the cost. In Q3 of 2025, amid all these investments, they reported a net loss of $97.771 million.
Almost $100 million quarterly loss. That's a headline that scares people. If they miss their schedule by just a year, does that 11.5 current ratio hold up?
And that's the core question for the bear case. That balance sheet gives them runway, but only if the execution is tight. The risk is that scaling up rare earth separation is technically complex and it takes longer than planned. That burns through the cash.
Which brings us to the biggest hurdle they face, execution risk. And it's really a war on two fronts for them, domestic and international.
Domestically, the challenge is the timeline for ramping up commercial-scale production at White Mesa. They've proven the capability, but going from a pilot to full-scale profitability, it takes time, and you have to avoid expensive technical mistakes.
And then internationally, you have Armada in Madagascar.
Yeah.
The complexity there is, what, 10 times higher?
At least. The primary risk is just getting the permits and infrastructure built for a project that massive in a developing nation. Now, the recent government suspension was lifted, which is good news.
Huge news.
But international development, logistics, power, transport, it's complex, it's slow, and it's always subject to political changes. It's a totally different risk profile than operating in Utah.
So this creates these conflicting views among analysts. You have the optimists looking at the potential, but then you have the persistent bears who see the rare earth strategy as just a giant capital sink for now.
And until those rare earth revenues are flowing consistently, those valuation concerns are absolutely going to linger. But that brings us back to where we started.
The uranium business.
That cash flow from the uranium side gives them a substantial buffer to manage these risks and delays. It's their strategic cushion.
Okay, now that we've balanced the bull and the bear, let's look forward. What should someone holding this stock be watching for in the next 90 days?
Concrete milestones. The biggest date on the calendar is the next earnings report, February 25, 2026. This is the first big update since that record Q4.
And what are we looking for in that report?
Two things. First, confirmation that uranium sales growth is still strong. Second, and this is more important, an update on the rare earth ramp-up. Are they hitting their startup milestones at White Mesa?
We also need follow-up news on Armada. Since the suspension was lifted, what's the timeline? What's the path forward for that $1.8 billion project? Any clarity there will dramatically de-risk the long-term story.
And finally, you just can't talk about this company without connecting it to the huge macro tailwinds pushing the whole sector.
The environment is incredibly favorable for both sides of their business. Let's start with uranium.
Uranium demand is surging. It's driven by two massive themes. First is just global nuclear capacity growth. Nations want clean, reliable, non-fossil fuel power.
And the second theme, which is newer, is the AI boom. Data centers require immense, constant 247 power that you just can't get from intermittent sources alone.
Exactly. The power demands from AI infrastructure are tailor-made for what nuclear provides. That creates a structural tailwind for their core product for the next decade at least.
Then, on the rare earth side, they're perfectly aligned with U.S. policy wanting domestic critical mineral supply chains.
Correct. So you combine surging uranium demand with a government push for technological independence, and Energy Fuels benefits from this massive tailwind on both sides of its business. It's a company built to solve two national security problems at once.
So let's tie it all together. If we had to summarize the core investment thesis here, what's the final takeaway?
The thesis is that this is a multi-year play that really hinges on execution. It combines stable, protected cash flow from their U.S. uranium leadership with massive optionality from the rare earth strategy.
And that high-value Varamata project provides the long-term horizon, the potential upside that justifies the valuation premium today, assuming they navigate all that execution risk we talked about.
Right. And if we connect this back to the bigger picture, here's a provocative question for you to think about. Given Energy Fuels' status as the sole conventional U.S. mill operator, how critical is its success to America's energy security goals? As global demand for nuclear and critical materials just keeps accelerating, their ability to execute might become less of a market story and more of a national strategic priority.
A fascinating thought to leave you with. It's about security and technology as much as it is about portfolio returns. Thank you for joining us for this deep exploration of the fundamentals driving the price action in Energy Fuels. We'll be back next time with another Market Move Simplified. Tune in then.